The statistical reliability metric is a measure of how reliable the data is for a property market. Data is not always available for every property market. There is almost always some data, but rarely is there ever a complete list of stats with no omissions. What's more, some metrics for a market may be reliable, so for example the percentage of stock on market, but other indicators for the same suburb, like say the auction clearance rate, may be unreliable. The statistical reliability score only concerns itself with market data that is used in calculating the demand to supply ratio. The demand to supply ratio is an overall score of the investment potential for a property market. It considers many variables. The same variables that go into the calculation of the demand to supply ratio are also examined when calculating the statistical reliability. So the statistical reliability, or SR for short, is effectively a measure of how reliable the demand to supply ratio is. A suburb may have a high demand to supply ratio or a low demand to supply ratio, but whatever the suburb's demand to supply ratio is, you cannot rely on it if the statistical reliability is low. The SR is a score out of 100. The higher the SR, the more reliable is the demand to supply ratio. The calculation is geared to make a score of 50 the pass mark. Investors aiming to buy in suburbs with SR scores below 50 are thought to be taking too much risk. However, each investor has a different appetite for risk, and there's always some risk in investing, even with an SR of 100, which I've never seen. Note that the vast majority of Australian suburbs are extremely remote, and they have very small real estate markets that are infrequently traded. And this means there is very little data, and they are therefore highly unreliable from a data perspective. So keep that in mind whenever consulting a context ruler to figure out what a good value for statistical reliability might be. Now, some of the things that affect reliability include things like volume. That's how many observations. For example, an auction clearance rate based on 10 auctions is more reliable than an auction clearance rate based on only 1. Volatility is another indicator of unreliable data. Volatility can be seen sometimes in historical charts. That's where the curve on the chart might bounce up and down radically from month to month. Supporting statistics is another consideration. So if we have data from multiple sources that are all saying the same thing, then we have more confidence than if those different sources contradict one another. And currency or recency of data is another concern. So if data is out of date, recent changes to the market may be very different to what we expected. So data is scored based on how recent it is. Now, our policy is to publish some data on every market, but to publish that data along with a statistical reliability figure. Then it's up to the investor to decide if they're prepared to accept a bit more risk or not. So make sure that before basing any investment decision on the demand to supply ratio, you firstly check the suburb's statistical reliability.